Hey everybody, welcome back to another video here at Adora Trading. I personally tend to focus on indexes as a trader, but I thought I'd switch things up and provide some gems to my Forex traders. So today we're going to dive into adding a new dimension of intermarket analysis to your trading that will get you out of the loop of endlessly scanning the charts and struggling to find profitable trades. In this video, I'll be expanding on some ICT gold that will provide you with the skill set to find consistent daily setups in the Forex market. So let's get right into it. So looking at the daily chart here on dollar index, we've been seeing that dollar and all the other majors have been in a consolidation. Looking at dollar, let's compare euro as well as pound. So as we know, when the dollar goes into consolidation, the other dollar-based currency pairs will also tend to be in a consolidation as we're seeing here. So what are some ways to find consistent setups in the Forex market? What I do that I learned from ICT is that we then take our attention to the cross pairs. Reason being is that whenever the dollar is held in consolidation, this will allow the cross pairs and the central banks to manipulate those pairs and move them. So we'll typically see those pairs trending when the dollar is held in a consolidation, as all dollar-based pairs will also consolidate. So as I've said, we'll take our attention to the crosses. So now before we go into the specific cross that we're going to look to trade, we want to look at the two currencies that make up that cross so that we can determine our bias. So taking a look at the euro here, looking at this consolidation that we're in, this is the price action we'll be primarily focused in, is when we were inside of this higher time frame daily consolidation. And let's overlay that with pound. So here's a quick down and dirty way to get a bias in the cross pairs using the currencies that make up that cross. So here, looking at this shaded purple region, we want to determine which currency pair is stronger than the other one. So if we're going to be looking at the cross Euro GBP, we want to look at the Euro USD and GBP USD to determine our bias, as I've said. So looking at that, we want to look at which currency pair is stronger and which is weaker. So here in this case, we can clearly see that the euro was much weaker, unable to make higher highs while making newer lows, whereas we see here that the British pound was making higher highs and expanding on the upside. So if we're going to look at the euro pound, we're going to have a bearish bias. Reason being is because GBP is the second name in that pair and the euro is first. So because pound is stronger, we will expect that cross pair to be bearish. So before even looking at that pair itself, we already have a bias and framework that we're going to be looking to work within. So getting right into it here, looking at the euro pound, as we've determined, our bias is bearish without even looking at this chart by just looking at the individual currencies. So now let's take a look at this chart and look at some technicals that would further solidify our bearish bias. So let's go up to a weekly. Not much here to say other than a consolidation in a premium. We have relative equal lows and a discount inefficiency here in the form of a BISI that the market will want to trade down into. So let's drop down into our daily chart. So as we can see here, when the dollar is held in a consolidation, as we see here these past few weeks, this allows the cross pairs to move much more freely. And then let's look at this region here. We see dollar index sideways consolidation, and this frees up the cross pairs to trend and move with directional clarity. So with this, you'll be able to consistently find setups in the Forex market, even when majors are in consolidation. So now let's look at the technicals here on a daily chart. We are trading within a parent dealing range from this low to this high. We've been trading in premium for a while, failing to mount any rallies higher. And then with the bias that the euro and the pound dollar crosses are giving us, we are looking for lower prices. So let's look at the technicals and see what would confirm that. So looking here at this region of price action, looking at the past couple weeks, we're looking for lower prices. What specifically would the market be looking to draw into? So at first glance, we have relative equal lows. as smart money traders, this is what we're looking to target. These are less informed speculators that have liquidity below these lows that we will be looking to target, accumulate shorts in premium, distribute in discount. So then what else do we have inside the discount below this equilibrium point that the market would want to draw into? We also have this fair value gap here and extend that inefficiency through. Another draw on liquidity. So now that our daily bias is bearish, we're trading within this parent dealing range. Let's start refining where we're trading at the current recent market price. So within this price leg, we were trading within this lower time frame dealing range. And we see here that the market traded up to a premium, rejected. We now have buy stops above this high. Price trades back up into that high, which is also has a breaker, high, higher high, down close candle within that price range. We would then look to extend that through. And we are still seeing respect for these price levels. So I'm seeing this as a run on stops because now we have relative equal highs here and here. So that would be our buy side liquidity. So why is that significant? If we're looking for lower prices, there needs to be buyers for us to sell to. So these relative equal highs trips in either protective buy stops or traders looking to trade the breakout. Smart money is looking to sell short there. So what I like to look at here is how we trade above the highs. Are we seeing aggressive expansion and willingness to continue? Or are we seeing an anemic run higher with a sweep and then displacement to the downside? So because we're seeing lack of displacement through the highs with strong energetic runs through the lows, this gives us our pretext to anticipate lower prices because now we're trading in line with institutional order flow on a daily, weekly level. So looking at this price action here, we traded up to the relative equal highs, rejected that with a strong displacement lower. So many of you guys may recognize this as the ICT 2022 model, which would be buy side liquidity purged, displacement lower, shifting market structure here, return to fair value gap, and then marking out this fair value gap. Further confirmation for bearish order flow is the fact that these bodies are beautifully respecting that. So wicks do the damage, bodies tell the true story. The wicks can color outside the lines. We want to see the bodies respect the levels we're looking at. So we also have a bearish breaker in here, high, higher high, lowest down close candle within this price range. We want to extend that through. So making that purple, this would be our bearish breaker. So lowest down close candle here, extend that through. This is our breaker. So the retracement can go highest point on this down close candle. So we're seeing beautiful respect for our discount levels. So now that we're seeing the technicals line up with our bearish bias, what would be a target? As we've already highlighted, relative equal low sell side and this discount inefficiency. So with that being said, now let's drop down into our hourly and start looking at some intraday timeframes and see how we can take advantage of these price moves inside of the cross pairs, given that the dollar index is in the higher time frame consolidation. So we're going to mark out our midnight opening for each day. So let's look at this week here and break down this price action. So keeping in mind this blue level here is our daily fair value gap, and here is our Monday opening. So here we have a full trading week, Monday, Tuesday, Wednesday, Thursday. So the bias is bearish. We're looking for lower prices. So as smart money traders, looking at the templates that ICT's provided to us, we'll typically anticipate a high of the week when bearish to be made on Tuesday or Wednesday. So in this case here, it was Wednesday. So now looking at this dealing range, refining the price fractals that we're trading in, we have an opening here on the new week. So is it just going to open and immediately run to this line here, which is our sell side liquidity relative equal lows on the daily, and then this purple is our daily discount inefficiency? Would we expect price to immediately just open and run down to those levels? No, we would forecast some type of power of three, which is open, accumulation, manipulation, distribution. So looking at this lower time frame dealing range we're trading within, and we can take off this daily level, we'll anticipate some measure of premium to be traded to. Why is that advantageous to us? Because as smart money traders, we want to sell the market when it's expensive and buy it back at discounted levels. So here we see our opening, Monday rally, Tuesday rally, making a Wednesday high of the week. So what's interesting here is how we make this swing high. In a premium above equilibrium, 50%, we trade higher, run out the buy stops, and then immediately displace lower. So you guys may also recognize this is the 2022 model, which is high, buy side taken, displacement lower, shifting market structure with a fair value gap. And then you would be able to sell short the fair value gap. And as I've already highlighted, why is this a good shorting opportunity? Because we're above that equilibrium within the hourly, but we're also above that weekly opening price. So you're ensuring that you're selling at a deep premium, which is what we look to do as smart money traders. So looking at this price action here, high of the week on Monday, displacement, fair value gap traded to. One thing I do want to highlight is look at the order flow around the highs and lows, and we can use that to determine the state of delivery. So because we're running through these highs very anemically here, this swing high taken out extremely anemically, this high here, weak lethargic run above it, all the energy's on the downside displacement through these lows. So that's a further indication of institutional order flow, and in this case, that is bearish. So here we see after Wednesday makes our high of the day, we then displace lower into Wednesday, attacking the sell stops below here. Thursday expands lower, attacking all this liquidity, and then Friday takes us into our higher time frame objective, being sell side liquidity pool on the daily chart. And then into next week, we then drop down into that daily discount inefficiency. And that's a wrap on learning how to be consistent in the Forex markets by use of these intermarket analysis techniques. I hope you enjoyed this video and found it to be helpful. Be sure to subscribe, like, and comment what you thought. And if you want to learn more about all things trading related, hit that notification bell to be notified for future videos.